What is going on, people? Welcome back to the channel. Today is Tuesday and that can only mean one thing: 2-minute Tuesdays. Hedge funds, where to start? Okay, let's break it up. To hedge is to protect money, and a fund is a pool of money. So a hedge fund in essence is meant to protect money. And so that's it. That's what hedge funds mean. That's this week's 2-minute Tuesday. Hope you enjoyed it. Peace. I'm playing. That in essence is what it is. So next time you hear hedge funds, think hedge, protect, funds, money, protect money. That's what they were meant to do back in the day when they first got created. But as time went on, hedge funds got more and more risky. They started taking bets in both directions of the market. They started betting on companies to fail. People started losing a lot of money because they were taking outrageous risks, and so hedge funds started getting a bad name, and so that protecting of money kind of went out the window. So hedge funds take money from their clients, wealthy individuals, companies, corporate pension funds, whatever it might be. They take money from clients and they invest that in the financial markets. But what's important to know about hedge funds is that they take a high level of risk. So that can mean big returns, so big profits, or it can mean huge losses. So that's the risk you take when you're investing with hedge funds. So one thing to know is the reason that they can take all these high levels of risk is because they're not as regulated as other parts of the financial markets. And so the average person isn't allowed or can't invest as much with hedge funds. You have to be a certified investment professional. So you have to be considered officially an investor to invest with hedge funds, because you need a certain level of understanding to know what you're getting yourself into. A very important part of hedge funds that you need to be aware of is they use a lot of leverage. What is leverage? Leverage is basically multiplying or magnifying your trades by taking on debt. So you're borrowing money that isn't yours and you're using that to invest in the market in order to get more returns. An example would be, let's say a hedge fund takes £100 from its clients, and then it can invest that £100 in the markets, and if everything works out, it might make £500 or £1,000, right? However, what hedge funds do is they take on leverage, they take on debt. So they borrow £1,000 and they get their clients £100, so they get £1,100, and then they invest that money into the financial markets, and so that increases the potential return to £5,000 or £10,000 instead of £1,000. So they borrow money in order to increase or magnify the potential of their returns. So let's say they make a huge profit, they give back the money that they borrowed plus interest, and then they keep the rest of it, right? For them and their clients, they make huge amounts of profit, they make big returns. However, if their trades and investment ideas don't go as planned, that's a lot of leverage that is going to play against them. So they are going to be suffering massive losses. And this is why hedge funds have a bad name. They take huge amounts of leverage, they take huge bets in the markets. When they work out, great. When they don't, it's enough to wipe the hedge fund out. It's enough to close firms. Previously, we've touched on the concept of asset classes in the financial markets. These are the different flavors of the financial markets that you can invest in. Some hedge funds might invest in fixed income markets, some might just focus on equity markets, some might focus on real estate. So if you're ever considering to break in or apply to hedge funds, it's important to know why you're applying to a given hedge fund and which area you're interested in specifically and why. Because hedge funds take a lot of risk, they need to be compensated accordingly. As a result, they charge pretty high fees compared to the rest of the market. Typically, hedge funds fee structure is 2 and 20. What that means is 2% management fee. Clients invest money, 2% goes to the hedge fund for managing their money, investing it, all of that. And then the 20% comes in if they reach a certain level of return or percentage of profit from their investments. So the client might say, okay, if you reach this percentage return after a year or 2 years, then you get 20% of the profits above that level. So it incentivizes the hedge fund to kind of knock the lights out or hit the ball out of the park, and that's why that further increases the incentive to take bigger risk, to kind of get bigger returns, to get a larger cut from the overall return as a 20% fee for performance. Now you know what a hedge fund is. What if I asked you, do you know what asset management is? If you don't, make sure you check out this video. If you made it this far in the video, I've got 2 jobs for you. One is to smash that like button. If you do that, you're basically telling YouTube that this video is worth people seeing. And 2, leave an emoji in the comments so I know that you made it this far. Anyways, make sure you tune in next week to learn another financial term, concept, or idea in basic English. Peace.